Assalamu alaikum. So today is the third lecture of Advanced Finance for Business Managers. Understand how costing techniques contribute to decision making. There are three procedures for this. First one is break-even analysis. Break-even analysis in cost accounting refers to the point where total cost and total revenue are equal. Likewise, if the total cost of the product is, say for instance, 2 lakh, and the revenue earned by the business is also 2 lakhs, so this means that this is the point at which the total cost of the product and total revenue means profit, both are equal at the same time. The break even point or the break even analysis is used to determine the number of units or dollars of the revenue needed to cover the total cost. Number of units like 0, 1, 2.1, 3.1, and dollars when we talk about the profit of the company. Like we talk about company, the foreign company is earning their profits in dollars. If you talk about Pakistani company, so Pakistani company earned their profit in rupees, not in dollars. There is an example of break-even analysis that I have given here. The costs are fixed for the product. Like if we buy the tea leaves for our houses, it costs 680 rupees, it costs 800. So it is the fixed cost, the cost that is not changeable at any cost. The company fixed that prices. You are not allowed to bargain with them related with the price. Like if we go to the supermarkets, if we go to the journal stores, maybe with the shopkeepers of journal stores, you will bargain with them and they give you the products on the discounted prices. But as we talk about the big departmental stores, like in Pakistan, if I talk about Pakistani stores, Victoria departmental store, Al Fateh store, Euro store, these are the stores on in which the product price is fixed. Colin is a person who is a managerial accountant in the company in which they sell water bottles. He previously determined that the cost of the company is fixed. It consists of the basically property taxes, lease, and the salaries of the employees which are working there. All these costs are added up and the total amount is 1 lakh. The cost of one bottle, the cost which is linked with producing the one bottle is rupees 2, sorry, dollars 2 per unit. So the water bottle is sold at $12, not on $2, because the producing cost is per unit $2. But when we are going to sell the product in the market, we sell it on our own price, our own procedures. When we visit any store, likewise, if we purchase clothes from online brands, the clothes we purchase from them are also on the fixed price. If they purchase the 5 suits, for example, I said they purchase the 5 suits rupees 10,000. But when they are going to sell the suits, they first have their profit on it and then they sell the product. So the bottle that is sold on the price is $12. So now we want to check the break-even point of A's premium water bottle. Now, $12 minus $2. First of all, we subtract it. The answer is 10. Then, with 1 lakh, we divide $10. By subtracting $12 minus $2, the answer is 10. Now we are going to divide 1 lakh with the answer of 10. Then you will get the answer 10,000 units is the total break-even quantity for the company who want to sell their water bottle on the premium price. Now you can divide it and also check the total answer. So the answer is 10,000 units. So it means that the company will need to sell 10,000 units of water bottles to the break-even analysis, where total cost and the total revenue are equal. Next graph. This is the graph of break-even point, number of units, and first of all, there are two parts of the graph. First one is x-axis and second one is y-axis. This is called this line is x-axis and this line is y-axis. Here number of units have been written. 2,000, 4,000, 6,000, 8,000. These number of units will be changed. Maybe 2.1, 2.2, 2.3 or 30, 40, 50. Here dollars. Now the line which goes straight shows the revenue of the company. The blue line shows the revenue. The red line shows that there is a fixed cost. And yellow line represents the total cost, like variable cost plus with fixed cost, and where these points are made is known as break-even point. I'll explain you with the explanation of the graph. I have also written the explanation here. So the red line here represents the fixed cost. The fixed cost is $1 lakh. The example says that the fixed cost is $1 lakh. The blue line represents the revenue per unit sold. Like 10,000 units would generate. Selling 10,000 units would generate. Here is the answer 10,000 units. The 10,000 units will generate here. And this is the premium price, $12. 10,000 units and $12. The $12 is the premium price of the bottle. Then 10,000 units multiply by 12. 12 is the premium price of the bottle, that in this price the product is going to be sold. They manufactured water bottle. So 10,000 is the units that would generate. 12,000 is the premium price of the bottle. 10,000 multiplied by $12, and the answer is $120 in revenue. That $120 is the profit. Revenue means profit of the company. When you multiply $10,000 with $12, the answer is 1,20,000 in revenue dollars. Now we talk about the yellow line. Here is the yellow line. The yellow line says the total cost. The total cost is fixed. In bracket, I have written fixed and variable cost. For example, if the company sells 0 units, then the company will incur $0 in variable cost. But the fixed cost is $1 lakh. Here is the fixed cost. Fixed cost is $1 lakh. It is mentioned here that the fixed cost is $1 lakh. So total cost in fixed cost for total cost is also $1 lakh, because fixed cost is the total cost. There is no other cost is added with it up. Here total cost and fixed cost are the same. The company sells 10,000 units. Here I have written 10,000 units. This is the answer of break-even quantity, 10,000 units. The company would incur 10,000 units, and the 2% is the water bottle price per unit that is producing one water bottle. This is the variable cost. Dollars per 2 unit is the variable cost of the water bottle. So 10,000 multiplied by dollars 2 and $20,000 is the variable cost. And 1 lakh is the fixed cost, and here this 1 lakh $20, it is the fixed cost, and for total cost is 1 lakh $20,000. The break even point is at 10,000 units. This is the break even point. The break even quantity is 10,000 units. The revenue will be 10,000 multiplied by $12. $12 is the premium price. The price at which the bottle is sell is $12,000. So the answer is 1,20,000, and it would be $10,000 multiplied by $20,000 in variable cost, and $1,000 is fixed. 1 lakh, sorry, $1 lakh is fixed. You are not allowed to change this number as it is written in the example that $1 lakh is a fixed cost. When the units will increase by 10,000, the company will making a profit on the unit sold. This blue line is greater than with yellow line. The blue line of revenue is greater than with the total cost. After when the 10,000 units are produced, the blue line of revenue is greater than the total cost. Likewise, if the number of units is 10,000, the company would be go into loss. If the units is below 10,000, if the answer is not 10,000, if the answer is 9,000, if the answer is $8,000, $6,000, then the company will go into loss. So from 0 to 9 and 99 units, the total cost line is above the revenue line. The total cost line is above the revenue line. If the units are under 10,000, if the answer is likewise, say for instance 8,000 or 7,000, then the company will go into loss. If the answer is 10,000, then the company is going to earn the profit. Here you will note a thing that here 20,000 variable cost, here 20,000 variable cost is same. 1,20,000 and 1,20,000 is same. This means that the total cost 1,20,000 and the revenue $1,20,000 is same. This 1,20,000 total cost and the revenue they are going to be earned is $1,20,000. So that is why it says that the total cost and the total revenue is equal in break-even analysis. Now, break-even analysis as a tool of decision making. Here we talk about break-even analysis as a tool of decision making. Break-even analysis helps business a lot when businessman wants to make a decision. The decision is about the new product, how many units they will need to be sold, how the business can judge whether which price is realistic, how will they do the market research. So break-even analysis will help the business and the businessman to make a decision. Here are some points I have written. First one is new product. The break-even analysis is going to predict. Predict means assume, forecast how many units they will need to be sold. So the business can judge whether this would be real, and it should be based on their market research. The businessman will research whether through internet source or whether by visiting different markets, he will take an idea and then he will going to manufacture the new products. Then comes pricing. Pricing uses different strategies. It might affect the break even point and the profits of the business. When there is change in price, when there is different price strategy, so it will affect the profit of the business too. For example, if the rate of I want to purchase cooking oil, the gourmet bakery sells the cooking oil of rupees 670, and the local shop that is in your area, they will give you the same oil in 540 or 550 rupees. So there is different price strategy, and obviously it affects the profit of a business too. The person who is giving the oil in 540 rupees, he is also going to earn the profit, and the person who is working as an employee in gourmet bakery, he will give you the same oil in 670 rupees, because the person who is the employee in gourmet bakery, they will pay the taxes for electricity, they have to pay the electricity bill, they have to pay the tax, they have to pay the income tax, there are a lot of employees working there. But the person whose shop is in your area is the owner, he is the sole proprietor, so he didn't need too much profit, that's why he give you the same product in less price. So this is how the different price strategy will affect the profit of the business. When the businessman charge the higher price of the product, it will increase its profit, but the break even point is lower, and when the break even point is lower, they didn't meet together, like total cost and total revenue is not equal if the break even point is lower. So this is how increases in price can result in lower sales. If gourmet bakery is selling their prices, is selling the products on high prices, I didn't prefer these products, I prefer the products from my nearby stores, because they give me the product on the low price. So when prices are increased, there is low sale in the market. Likewise, near Eid festive, when the Eid festive is near, we survey the market, we purchases the dresses. If the dresses are of too much high, cost too much high, we didn't purchase the dress from that shop. We always survey different markets to find the product that it is in our budget. If the price increases, the sale is low. It could increase the break even point. Cost. The break even point can highlight the impact of changes in the fixed cost or the variable cost. This will help suppliers, the suppliers who are going to supply the product in the market. They are the persons who are responsible to dispatch the products to the market so that the consumers can purchase the product from the markets. So if break even point highlights the changes in whether fixed cost or in variable cost, this will help to decide whether to change the suppliers or whether to invest in new things. If the business is able to decrease the cost, the break even point will fall. And if the break even point will fall, it means that the company is going into loss. Production levels. When we talk about the production, we want to sell the products in order to make the profit. This will increase the production level of the business. So the break even level can be used to plan What equipment? Equipment means what machinery they needed and how many staff might be needed in the production department for manufacturing the product. Any question regarding this first point?
No.
Okay, I am giving you 20 minutes. First think on it and then give me answer one by one. My first question is from you. What is break-even analysis and what is the example of the break-even analysis? First of all, I'm giving you 20 minutes. First think on it and then give me the answer.
Okay. So break even is um break even is a point where the total costs are equal to the total revenue. It is used to it is it is used to determine how many units are needed to cover the total cost. So for example, um, uh,
Okay.
a furniture store um, has a fixed cost of of um, of $200,000 and its selling price is uh is $50 and its variable cost is like $30. Um so
So how will
so
you
its break
calculate the
even would
break-even
be.
quantity? Okay, if you are changing the amounts, so then tell me how will you calculate the total break-even quantity?
So its break even quantity you know uh would be like uh would be like $10,000 because 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 like 50 minus 30, like
What is the
50
answer?
is the selling price and variable cost is and like 30 is the variable cost, and then so then like so then like 200,000 uh divided by like divided by 20, it is like $10,000. So that would be the break even.
Yes.
So yeah, the company would need like 10,000 like units to sell.
Okay, this is the graph and I have explained you the graph. I am again giving you 15 minutes. First thing on it and then start explaining me the graph.
Okay. So on the x-axis there are number of units and the y-axis has has the quantity. So yeah. So red line, uh, the red line is the fixed cost, you know, uh, which is like the same. So like it
Giving you 15
doesn't
minutes
change.
again. The slide is in
Sorry.
front of you where I have explained the graph, total graph. Read this,
Yeah.
then think on it, and after 15 minutes, give me your answer.
Okay. So on the graph, uh, on the x on the x axis there are the number of units and
On y
on
axis,
the y they they're
okay,
the dollars.
this is a graph. The red line shows that there is a fixed cost, and the fixed cost is, as I have explained in the example, that the fixed cost is 1 lakh dollars. The red line represents the fixed cost. Then the blue line represents the revenue. Revenue is the profit and the units that are going to be sold. The selling units are 10,000 units. This is the answer, 10,000 units. 10,000 units and $12 is the premium amount on which the product is going to be sold. So when you multiply 10,000 by 12, the answer is $12,000 in revenue. The yellow line shows the total cost. For example, if the company is not selling any units, so it means that there is no variable cost, but the fixed cost remains the same. If I am not selling any product, then I have no variable cost. So the dollars 1 lakh is the fixed cost. The fixed cost and the total cost is the same. The company is going to sell the 10,000 units. Here the answer is 10,000 units. These are the $10,000 units that are going to be sold. $2 is the, this is the $2. $2 is the per unit price of the water bottle. So when 10,000 multiplied by dollars 2, it is dollars 20,000. Now we will get our variable cost. $20,000 is the variable cost and $1 lakh is the fixed cost and total cost is $1,20,000. The break-even points are 10,000 units. The revenue at this point will be $10,000 multiplied by $12, the amount that is going on which amount the on this amount the water bottle is going to be sold. The premium amount is $12,000. So 120,000, $1,20,000 is the revenue, total revenue, and $10,000 when multiplied by $2, the answer is $20,000. It means here you see that $1,20,000 and $1,20,000. Then you see that there is $20,000 and here also written $20,000 and fixed cost is same. So here both answers are $1,20,000. This shows that the total cost and the revenue cost are equal. When the numbers are increases by 10,000 units, the company is going to earn the profit. 10,000 units means that when, for example, when a fabric company is going to sell the products in the festive season, like Eid ul Adha is now coming. It is a festive season for all the Muslims all over the world. So we purchase the new dresses on Eid. So if they increase the prices, like if the actual cost of the price is 3,000 and on that festive season they are going to sell it at 7,000 or 8,000 rupees, this means that the price increases. Units means price. The price increases. When the price increases, this means that the company is going to make a profit. This blue line, revenue line, is greater than the fixed cost line, total cost line, sorry. This blue line is greater than the total cost line. If the company is going to sell the units, if the number of the units is below 10,000, likewise, if any company or if any brand is going to sell the dresses on the actual price and they are not taking any profit on it, this means that they are going into loss, because every businessman do the business on the basis of profit, and if the he did not earn any profit to the business, then the business will go into loss. So line, the total cost line is above the line of the revenue. This is the total cost line and it is above the revenue line. The revenue line crosses the total cost line. It is above the revenue line. Now clear?
Yes.
Yes, please. I'm giving you 15 minutes. So please first think on it and then give me the answer.
Okay. Okay, so on the x-axis there are the number of units, and on the y-axis, there are uh there's the like amount in the dollars. Can you hear me? So on the x-axis there are the number of units, and on the y-axis, you know, it is the amount in dollars. So so the red line, it is the it is a fixed cost, which is $10,000, and then and then the and then and then the blue line, it it represents revenue. Um, so so of course, like the revenue, it is 120,000 dollars, and then and and then the yellow line, it is the total cost, which is
Yes,
uh
please.
which is variable and a fixed cost both. So you know so like you know so like when the company sells 0 units, its variable cost would also be 0, but but its fixed cost would like still remain $100,000. And so and so when the and so when the like business like produces 100,000 units, its fixed cost would be 20,000, and sorry, its variable cost would be 20,000, and its fixed cost would be 100,000. So the total cost would be 120,000.
One lakh twenty
And
thousand dollars.
yeah, and so the uh break even point would be at like 10,000 units, where the revenue would be one you know would be like 120,000, and the like total cost would be and the like and the like total cost would be like 1 lakh and like $20,000 too. So like they both would be the same. And and then when and then when the company uh like produces more than 10,000 units, then it will make a profit. But then if it sells but then if it sells less than like 10,000, then there will be a loss.
Okay, now comes to marginal cost. Marginal cost is the cost to produce the unit of production. It is very important cost in the cost accounting as it helps the marginal cost to check the efficient level of production for the manufacturing process. It is calculated by determining the expenses where occurred if only one additional unit is manufactured. If the one additional unit is manufactured, then it determines the total cost. Here I give the example that the manufactures high quality exercise equipment like the equipment that used in the gym for exercises. The company has both cost, variable cost and the fixed cost. And the company has the additional capacity to manufacture the more goods. They have additional finance to manufacture the more goods. For example, if the cost of the company is 5 lakh dollars to manufacture 1000 exercise bikes, the company will said that they have additional finance and they will going to manufacture $400 on one additional bike. So the average cost of unit is $500. The average cost is $500 and the marginal cost for 1001 unit is $400. This is $400. This is the marginal cost of one additional bike. The average and marginal cost may be different because there are some additional costs that is based on the fixed expenses. They may not be as additional units when they are manufactured. Some additional costs are fixed cost. We have fixed expenses. Likewise, if you talk about microwave oven price, the microwave oven price is right now, for instance, I said 16 or 20,000 price. So this means that the marginal cost is differ because the fixed expense is present here and we are going to purchase the product. Not we are involving in the manufacturing of the product. We are not going to purchase one microwave oven, etc. We are just purchasing one microwave oven. We are not going to purchase two microwave ovens. So that's why it has been written here that there is different and there is a difference in marginal cost because the additional cost is sometimes maybe the fixed expense of the product. Maybe the actual price of the product is 12,000 or 13,000 and it costs 15,000 or 16,000. So the amount they are charging you, the extra amount, is the additional cost of the product and we are going to purchase the product from the market. We are not manufacturing the microwave oven. The marginal cost is calculated by dividing the change in the cost by the change in the quantity. Okay, I have explained this. I have made another marginal cost slide for you to understand it well. Marginal cost is the cost to produce one additional unit of production. Like if I'm a businessman or I'm a manufacturer, I am producing the soft toys, I'm manufacturing the teddy bears. So the cost that is produced on the production. Likewise, if I am going to manufacture 7 teddy bears, the 8th teddy bear is the additional unit of production and it increases the cost. The concept of the managerial cost help you to understand the level of production for the manufacturing process. It is calculated by checking or determining the expenses that are incurred if only one additional unit is manufactured. Like if 8 teddy bear is manufactured, it is the additional unit of the company. Here I am giving you the example of toys. Big Dynamo is a toy company that produces robot toys. Every month they produce 2000 robot toys for a total cost of 2 lakh. They expect to produce 4000 robot toys next for 2 lakh 50,000 dollars. The total amount of production is $2,000. Every month they produce the robot toys are $2,000. The production cost is 2 lakh dollars. The future production amount is written in the example. It is $4,000. And the next month amount is, it is the future production cost next month. So it is the future production cost, that is 2,50,000 dollars. Change in total cost, $2,50,000 minus 2 lakh. $2,50,000, the future amount is less from the total cost. The answer is $50,000. Now the change in the total units are, here future amount is 4,000 and they are going to produce the robot toys at 2,000. They invest $2,000. So $4,000 will be less from $2,000. The answer is $2,000. Now this $50,000 will be divided by $2,000 and your marginal cost for the robotic toys are $25. If you calculate it on the calculator, you will calculate it on mobile, you will calculate through your calculator, it will give you the same answer. The change in total cost is divided by change in total units. The answer is $25. The formula is for that, change in total cost divided by change in the quantity. Here is the graph. On x-axis units are written and on y-axis there is a cost of the product. Now when the cost starts increases, profit will also increase. The units when divided by the total cost, it will increase the profit of the company. The graph shows that it starts from cost of 5 and then it is going to be increased. The curve is increasing because the price when increases, it increases the profit of the organization. The marginal cost will also increases. The units price is always fixed. Maybe it changes in some scenario, but the total price, the total cost will change if we calculate the total amount for with the proper calculations. So it shows that here written marginal cost, here written units, here written cost. This shows that when the cost increases, the managerial cost is also increases when we are going to purchase when we are going to produce one extra thing, it costs us additional expense. Likewise, if I want to produce the Elmira, if I am the manufacturers of Elmira, I am going to manufacture 2 Elmiras and 1 Elmira is the additional Elmira. And when we are going to manufacturing the additional products, it will increase the expense, and when the expense increases, the marginal cost will also increases depending on the scenario. Marginal cost as a tool of decision making. Marginal cost is very valuable in making the decisions. It helps the management to set the prices, to compare the production methods. It set the production level, close the production lines, and choose that of which range products are going to be manufactured. The prices that are fixed, they are already set by the top managers. When the products are coming into the market, before sending them to the market, they set the prices of the market. Then they compare the production methods. Then production activity level, that how much activity, production activity level is going to be set. How they close that production. When one products are going to be manufactured, for example, if I'm going to manufacturing the iron, if I'm going to manufacturing the almiras, after sending them to the market, I will close that production and choose the range of products that are going to be manufactured for the next session or for the next year. So the managerial cost can easily applied. If there is problem, managerial cost is easily applied. And there are some difficulties and there are limitations in the marginal costing. It is a very useful technique. So this techniques help the businessman to make decisions about how they will run their business and how they will earn profit through the business. Any questions regarding this?
No.
Okay, I am going to give you 15 minutes. First, think on it and then give me the answer. This calculation is a part of an example. When you are going to do the assignment is the same. When you are going to do the assignment, you will use the graphs. You will illustrate the examples like this. Maybe you will illustrate graphs. You will give examples like as I give. So I am giving you 15 to 20 minutes. First think on it and then give me the answer so that we wind up the lecture and then go to the assignment section.
Okay. So, marginal costing, it is the cost of producing one more unit. It helps to determine the most efficient level of production process, its its formula is the change in quantity. Sorry, it is a it is a change in cost divided by the change in quantity. So for example, if a toy company uh wants to wants to increase its production, it will have to calculate the change in total cost and the total units. So if they are divided to get the marginal cost. Um so 250 so like two so $250,000 minus $200,000 divided by 4,000 minus 2,000. Uh so this will give you the answer um
The marginal cost
of
answer is
25.
change in total quantity divided by change in total units. $50,000 divided by $2,000 and the answer is $25. That is the marginal cost of the product.
Yes,
Yes, now
25 is the marginal
tell me
cost.
the formula and explain the graph.
The formula is the change in total cost divided by the change in the total quantity. So on the x axis there are units, and then on the y axis it is cost. So the graph shows that you know shows that shows that uh shows that the more like units are produced, the cost will also increase.
When we are going to purchase additional product, then the cost increases because we have to pay the additional expenses for the product. So
Yes.
tell me, marginal cost as a tool for decision making. Why we said that marginal cost as a tool for decision making? How marginal cost help businessmen or businesses in order to make the decisions?
So, so marginal cost uh, helps to set prices, and then it also and then it like also compares the production uh, methods, and then it like compares the production methods,
Managerial
and
costing
then
does not compare
it
any production. Managerial cost helps businesses and businessmen to make the decisions by setting their prices, by compare the production methods, by setting their production activity levels, by closing the production line after producing the products, and choose the new range of products to manufacture. So the managerial costing is very easy to apply it while we talk about the decision making. So there are some difficulties and limitations that are attached to the managerial costing, but this is a very useful technique in order to make decisions for the businesses. Now understand?
yes.
Okay, I am giving you 15 minutes. Think on it again, give me the answer, and then we'll move to the next slide. How marginal cost helps businesses in decision making?
So marginal cost helps to set prices, and then it like compares different production um,
Methods.
methods, and then and then it like and then it like sets the production levels, and then it like and then it like closes the production line, and then it like and then it like helps to see, to like decide which you know which products to like sell and manufacture.
The last point is sensitivity analysis. Sensitivity analysis basically is the financial model that determines how the variables are affected on the change in other variables that are known as input variables. Variables affect the change in other variables known as input variables. The variables affect the other variables in this case when the prices are too high. So it is a way to predict the outcome of any decision that is going to be taken by the businessmen or the businesses given a certain range of the variables. I have written example here. The financial expert examine the profit levels that may be achieved as a result of an investment in the machinery. A person is a financial expert. He is going to examine the profit levels that are going to be achieved on that basis if there is investment in the machinery. And by changing the expected demand level, altering means changing. By changing the expected demand level, the material cost, the equipment interruption percentage. Interruption means if there is problem in any equipment, the cost, and the outstanding value of the equipment. Outstanding amount is that amount that is yet to be paid. Formula is percentage change in output divided by percentage change in output. This is the formula for sensitivity analysis. Sensitivity as a tool for the decision making. So the sensitivity analysis is used for decision making by the managers, by the decision makers. This is very important application. It based on the decision model that can be fully used only through the repeated application of the sensitivity analysis. Repeated applications means the application that is going to be repeated twice or thrice. It helps the decision analyst to understand the uncertainties, the pros and cons means advantages and disadvantages, with the limitations and the scope of the decision model. Most of the decisions are made under the uncertainty conditions. It is the solution in decision making for making the parameters that are on the approximate figures. One approach regarding this is that replace all the parameters with the values, then carry out the sensitivity analysis. It is helpful for the decision making if he or she has some indication as how the sensitive will the choices to be with changes in one or more inputs. Assess financial implications for short run. In short run, the firms are only able to influence the prices through the adjustments made to the production levels. In short run, the firms are able to increase their prices through the adjustments when they are going to produce the things in the production house. But additionally, if a firm is in a monopolistic condition for the short term, then they may expect the competition in the long run. If for short term the company is in a monopolistic situation, they may expect the long competition in the long run. The monopolistic situation is for short term. But when we talk about the competition is not for the short term. The competition is for the long term and for long run. Any confusion regarding this slide?
No.
Then my question is from you. What do you think about sensitivity analysis and how it helps for business or businessman in making the decisions?
So sensitivity analysis,
Yes, please.
identifies how it identifies how target variables are affected by other variables called the input variables. Its formula is the percentage change in output divided by the percentage change in input. And then it is also a tool for decision making. It it is used by managers for decision making purposes. It it helps them to uh, it helps them to understand the uncertainties and the variables pros and cons.
At last, I have written here all these costing techniques support the financial implications of decisions, and these financial costing techniques contribute differently in this regard. Now, last slide is for assignment. Section 2 costing technique. The company decisions needs to make some short run decisions. About short run means not for too much time, short time period. The first one is that product mix. They need to decide how much of each of three different dinosaur soft toys to make in order to maximize profit and make best use of resources. A company needs to decide to produce three dinosaur toys so that they maximize their profit and make the best use of the resources they are have with them. Special orders. They need to make a decision about whether to stop production temporarily on one product line to order to fulfill a special order for large sports. Make or buy. They have found that one of the components they currently make themselves is available to buy from a Chinese manufacturer that need to decide whether they should make or buy the components. In this section of file, you will explain the information they need to collect and the costing techniques that could be support the financial implications of decision. The costing techniques I have already explained you that are break-even analysis with examples, with graphs, marginal cost with example, with table, with graph, and sensitivity analysis with just simple explanation. So the second point is that yes, they will have to make the decision on it that they have to stop the production temporarily on one product because they will get a large special order for the large supports. If they will stop the production for one product temporarily, then they will be able to fulfill the special order for the last port. This special order will give them the profit. Due to this profit, they will again manufacturing the one product that is stopped by them temporarily. When we get the large orders for the products, this means that it increases our profit. They will make us huge payment for this special order. When we produce or manufacture things on special orders, the party will give us the huge amount for this. After getting that amount, it means then amount is likewise, for example, 1 lakh, 2 lakh, 3 lakh. It depends on the order and also depends on the person that how much he will pay the amount for that product. So first of all, the decision for second point is that they will stop the production temporarily because they will have to complete the special order which is for large sports. The party will after given them the amount of huge amount or they will fill a check for it. When they will get enough amount for from the party, they will start again the production for one product line. Second is that make or buy. Component means part of machine or vehicle. They found that one of the component means they are going to manufacturing the part of machine or vehicle themselves in their own company is available to buy from a Chinese manufacturer. This product is also available on the Chinese website that the Chinese manufacturer, there is an option for them to buy the same product from the Chinese manufacturer, the same product, and need to decide whether they should make or buy the components. They, the answer for this is that they will make that component in their own factory because when we buy anything from the manufacturers will earn profit on it from us. We have to pay the taxes on that product to the manufacturer when we are going to purchase that product from them. If we make the same product in our own company, we don't have to pay the taxes. We don't have to pay them the extra amount to the workers. working in the company. So they will prefer to make that component in their own industry, and they will not prefer to purchase the same product from the Chinese manufacturers, as the manufacturers will sell them the product, sell the same product on high prices, because they will charge the tax for it, tax rate for it. So it is good for them to make the component in their own industry, and they will not be interested in buying the same product from the Chinese manufacturer, because no businessman is interested in investing more in the same product if he is already the manufacturer of the product. And yes, the fourth point is that the dinosaurs, they are going to make different softwares, they are going to make, helps them in maximizes their profit. And when the profit maximizes, with that profit they are going to use the best source of the sources they have after expanding the amount. When they will get the profit, they will use the resources in producing some other products. Any question regarding the assignment?
No,
Yes, Samreen.
no, everything is clear.
Okay, the deadline for this assignment is 18th June 2023. Any questions? Okay. Thank you very much. Inshallah, we'll meet in next lecture. Bye bye. Take care. Allah Hafiz and stay blessed. Good luck for task.
Bye.